Buckle up, everybody, because today we're diving deep into the world of Indian auto retail with Landmark Cars Ltd. You guys sent us a ton of interesting stuff for this one, financial reports, investor presentations, some industry news, and we're going to break it all down for you.
Yeah, it's a really fascinating mix of sources, gives us a really comprehensive picture of the company and what's happening in the Indian auto market right now.
For sure. By the end of this deep dive, you'll know how Landmark Cars is doing this quarter, but also you'll get a feel for the bigger trends driving the entire market. So are you ready to hit the gas?
Absolutely. Let's go.
Okay, first things first. Who is Landmark Cars? What makes them different in the crazy Indian auto retail scene?
Well, Landmark Cars is a major player in multi-brand auto retail in India. They've been around for 26 years, went public a while back, and their growth has been pretty amazing.
Yeah, from just one showroom in 1998 to 71 showrooms and 62 workshops across 11 states today. That's a wild ride.
It is, and that multi-brand thing is key to their success. Unlike those old-school dealerships that are tied to just one car maker, Landmark can partner with a bunch of different brands, so they can adapt to what customers want and jump on new trends.
So they're not putting all their eggs in one basket. They can ride whatever wave is hot in the market.
Exactly. And talking about hot brands, they're the top partner for some big names in India. Honda, Jeep, even Mercedes-Benz.
Wow. That's a serious lineup of partners. It says a lot about their reputation and how much the industry trusts them.
Definitely. Their strong relationships with these global giants give them a big edge in a competitive market.
Okay, so we've established that Landmark is a strong company with a good track record and a smart multi-brand approach. But let's zoom out for a second. What kind of market are they playing in?
Well, the Indian auto market has been like a roller coaster lately, especially for passenger vehicles. The Federation of Automobile Dealers Associations, FADA for short, they release data on vehicle registrations, and the reports are pretty interesting.
A roller coaster, huh? Tell me more about these ups and downs.
Well, in September, passenger vehicle sales took a nosedive, almost 19% down year on year. And part of the reason was that dealers all over India had way too much inventory, like almost 800,000 unsold vehicles.
Wow, 800,000 unsold cars. That's a lot of cars sitting around. What caused that inventory pileup?
It was a few things, really. Demand from customers cooled down a bit, and some manufacturers might have overestimated how much people would buy, so you had way more supply than demand.
The classic case of too much stuff, not enough buyers.
Exactly. But then, just when things were looking kind of gloomy, October came around and everything changed.
Hold on. So after that 19% drop, things suddenly reversed.
Yeah, sales went through the roof in October, a huge 32% growth year on year.
That's a crazy swing in just 1 month. What happened?
Well, the festive season in India, with big holidays like Diwali, always gives the auto market a boost. Plus, manufacturers offered some big promotions, and there were a bunch of exciting new models launched. All that together made people want to buy cars again.
So the Indian auto market is kind of unpredictable, huh? It can go from slow to fast in a blink.
It can, which makes it tricky to navigate. You need to be flexible and really understand what customers are feeling.
Which brings us back to Landmark Cars. How did they handle this roller coaster market in Q2? Did they get stuck in the September slump? Or did they ride the October wave? Let's dig into their performance and see what happened.
Let's take a look at the numbers.
Okay. Their revenue for the first half of the fiscal year was up a healthy 18%, reaching 24,316 million rupees.
Right, that's their pro forma revenue, which includes the numbers from the companies they recently acquired. To really see how their core business is doing, we need to look at the reported revenue, which doesn't count those acquisitions.
Got it. So what does the reported revenue tell us?
Even better news. Even without those acquisitions, Landmark's reported revenue grew by almost 19% year on year, reaching 17,392 million rupees. So their core business is strong even before we add in the potential from their new ventures.
Okay, so two ways of looking at the same thing. Pro forma shows us the potential impact of their acquisitions, and reported shows us how their main business is doing.
Exactly. It's important to consider both to get the full picture.
But things get a little more complicated when we look at their profit. Their EBITDA earnings before interest taxes, depreciation, and amortization stayed pretty much flat for the half year. But their profit after tax, or PAT, dropped by a whopping 86% year on year.
Yeah, that big drop in PAT definitely makes you wonder what's going on.
Right.
It seems like there's a specific reason for this, and it has to do with a major move Landmark is making.
You mean those 21 new outlets we talked about? Those got to impact their profits, especially in the short term.
Exactly. Think of it this way. When you open a new outlet, you have to spend money up front. like on building the space, training staff, and marketing. And then you have ongoing costs like rent, utilities, and salaries. It takes time for the revenue to catch up to those expenses and for the new outlet to start making money.
Yeah, it's like starting any new business. You got to invest before you see the returns.
Exactly. And that's why when you're looking at a company that's expanding quickly, it helps to look at adjusted figures. These adjusted numbers try to remove the impact of the expansion so you can see how the core business is really doing.
So it's like seeing the forest for the trees.
Exactly. And when we look at Landmark's adjusted EBITDA for H1 FY25, it comes in at 632.5 million rupees.
Okay, so the adjusted EBITDA looks more positive than the reported PAT. How does that compare to last year?
Last year, their adjusted EBITDA was 696.5 million rupees, so it's a much smaller decline compared to that 86% drop in reported PAT.
It seems like those adjusted numbers really do show us how strong their core operations are. It's a good reminder that the headlines don't always tell the whole story.
Absolutely. Context is everything, and that's where a deep dive like this can really help. So now let's look at Landmark's consolidated balance sheet as of September 30, 2024. This basically gives us a snapshot of what they own their assets and what they owe their liabilities at that moment in time.
Got it. A snapshot of their financial health. What are the key things we should look for on the balance sheet?
One thing that jumps out is their total assets. They grew a lot from about 15,514 million rupees in March 2024 to 18,074 million rupees in September 2024. That's a big jump in just 6 months.
Wow, that is a big increase.
Yeah.
Is that mostly because of those new outlets?
Mostly, yeah. Their investment in property, plant, and equipment, which includes stuff like land, buildings, and machinery, went up from 2,850 million rupees to 3,350 million rupees. This shows how much money they've spent on building those new locations.
So the balance sheet reflects their real-world investments.
Exactly. And we also see a big increase in their right-of-use assets, which are related to their leases for those new locations. This went from 2,371 million rupees to 2,929 million rupees, again highlighting the impact of their expansion.
And what about the other side of the balance sheet, the liabilities? What's changed there?
As you might expect, their borrowings have gone up both long-term and short-term debt, which is normal when a company is doing a big expansion like Landmark.
So they're taking on more debt to fuel their growth, which makes sense. But is that something to worry about?
It's something to keep an eye on for sure. We'll want to watch their debt levels in the coming quarters to see if their financing strategy is sustainable.
Makes sense. It's all about balance. You need to invest to grow, but you also need to manage your debt responsibly.
Absolutely. Now let's move on to the consolidated cash flow statement. This statement tracks the actual cash coming in and going out of the company.
Cash flow is king, as they say. Why is this statement so important?
It gives us a picture of the company's financial health in terms of their actual cash. Sometimes a company can look profitable on paper based on the profit and loss statement, but still be struggling with cash flow.
Ah, I see. So having healthy cash flow is really important,
Yeah.
especially for a company that's investing a lot like Landmark.
Exactly. And luckily, Landmark's net cash flow from operating activities was positive in H1 FY25, 1,084 million rupees.
Positive cash flow from operations. That's a good sign.
It is, especially when you compare it to the same time last year, when their net cash flow from operating activities was actually negative 159 million rupees. This turnaround means they're generating cash from their core business, which is super important as they keep investing in their expansion.
So even though their profits dipped, they're actually making money,
Mm.
which means they can fund at least some of their growth without just relying on borrowing.
Exactly. Now their net cash flow from investing activities, which includes their spending on things like property, plant, and equipment, was negative. But that's expected because they're putting cash into building those new outlets.
Right, because they're spending money to build those new locations.
And their net cash flow from financing activities was positive, which shows the money coming in from their increased borrowing.
Okay, so they're spending cash on investments, bringing in cash through financing, and most importantly, making cash from their operations.
Yep. So the cash flow statement shows us a company that's investing heavily in its future, using a mix of their own cash flow and outside financing to fuel its growth.
It sounds like they have their financial house in order.
I'd say they're managing their cash flow well, even with this big expansion program. But like I said earlier, it's important to keep an eye on their debt levels and how quickly those new outlets start adding to their profits.
Definitely key things to watch. These financials have given us a much better understanding of Landmark's financial health and the strategic decisions they're making. But there's more to this company than just numbers.
Absolutely. Numbers are just part of the story. There's a lot more to understand about Landmark's strategic approach and what makes them successful.
So stay tuned, because in Part 2, we'll dive deeper into those strategic highlights and explore what sets Landmark apart from the competition.
Welcome back to our deep dive into Landmark Cars Ltd. In Part 1, we got a good overview of their performance this quarter, explored their multi-brand approach, and looked at the roller coaster ride of the Indian auto market.
We did. And now it's time to get into the nitty-gritty of their financials. We've got Landmark's consolidated profit and loss account balance sheet and cash flow statement right here. But don't worry if numbers usually make your eyes glaze over.
We're going to break it all down in plain English and focus on what you really need to know to understand this company.
Sounds good.
I'm ready.
Okay. Let's start with their consolidated profit and loss account. This covers their performance for the first half of fiscal year 2025, or H1 FY25 for short, and we'll compare this to their performance in the same period last year, H1 FY24, to see what's changed.
Got it. Year-over-year comparison. Always a good way to see the trends.
Exactly. The first thing that pops out is their strong revenue growth. Their pro forma revenue, which includes the numbers from their recent acquisitions, hit a solid 24,316 million rupees. That's an increase of about 18.36% year-on-year.
Pretty impressive growth. But what about their reported revenue? The one that doesn't include the acquisitions. The one that shows how their main business is doing. Even better, I'd say. Their reported revenue grew by 18.75% year-on-year, reaching 17,392 million rupees. This tells us that their core business is healthy even before we factor in the potential from their new ventures.
So far, so good. But you mentioned earlier that their profit after tax, or PT, took a hit.
It did. Their PIT for H1 FY25 was 38 million rupees. That's a steep 86.4% decline compared to last year. But before we freak out, it's important to remember what we talked about earlier, their ambitious expansion strategy.
Right. Those 21 new outlets, those are going to impact their profits, especially in the short term.
Exactly. It's like this. When you open a new outlet, you've got upfront costs, like building the space, training staff, marketing. And then you've got ongoing expenses, like rent, utilities, salaries. It takes time for the revenue to catch up to those expenses and for the new outlet to become profitable.
Makes sense. It's like starting any business. You got to invest before you start seeing returns.
Precisely. And that's why when you're looking at a company that's expanding so much, it's helpful to look at adjusted figures. These adjusted numbers try to take out the impact of the expansion so you can see how the core business is really performing.
So it's like seeing the forest for the trees.
Exactly. And when we look at Landmark's adjusted EBITDA for H1 FY25, it's actually 632.5 million rupees.
Okay, so the adjusted EBITDA paints a rosier picture than the reported PAT. How does that compare to last year?
Well, in the same period last year, their adjusted EBITDA was 696.5 million rupees. So it's actually a pretty small decline compared to that 86% drop in reported PAT.
It seems like those adjusted numbers really do help us see the underlying strength of their operations. It's a reminder that the headlines don't always tell the whole story.
Totally. Context is key, and that's where a deep dive like this is so helpful. Okay, now let's shift gears and look at Landmark's consolidated balance sheet as of September 30, 2024. This basically gives us a snapshot of what they own their assets and what they owe their liabilities at that specific point in time.
Got it. Like a snapshot of their financial position. What are some of the important things to look at on the balance sheet?
Well, one thing that jumps out is the big increase in their total assets. They went from about 15,514 million rupees in March 2024 to 18,074 million rupees in September 2024. That's a pretty substantial jump in just 6 months.
Wow. That is a big increase. Is that mainly because of those new outlets they've opened?
Yeah, for the most part. Their investment in property, plant, and equipment, which includes things like land buildings and machinery, increased from 2,850 million rupees to 3,350 million rupees. This shows how much they've spent on building those new locations.
So the balance sheet is reflecting their real-world investments.
Exactly. We also see a significant increase in their right-of-use assets, which are tied to their lease agreements for those new locations. This went from 2,371 million rupees to 2,929 million rupees, further highlighting the impact of their expansion.
Okay. And on the other side, the liability side of the balance sheet, what changes do we see there?
Well, as you'd expect, their borrowings have increased, both long-term and short-term debt. This is pretty normal when you're financing a large-scale expansion like Landmark is doing.
So they're using more debt to fuel their growth. Makes sense? But is that something to be concerned about?
It's definitely something to keep an eye on. We'll want to watch their debt levels in the coming quarters to see if their financing strategy is sustainable.
Right. It's a balancing act. You need to invest to grow, but you also need to be smart about managing your debt.
Absolutely. Now let's move on to the consolidated cash flow statement. This statement is all about tracking the actual cash coming in and going out of the company.
Cash flow is king, right? Why is this statement so important?
It shows us how healthy the company is in terms of its actual cash. Sometimes a company can look profitable on paper, according to the profit and loss statement, but they might still be having trouble with cash flow.
I see. So having good cash flow is crucial, especially for a company that's investing a lot like Landmark.
Exactly. And the good news is Landmark's net cash flow from operating activities was positive in H1 FY25. It came in at 1,084 million rupees.
Positive cash flow from operations. That's good.
It is,
Yeah.
especially compared to the same time last year, when their net cash flow from operating activities was actually negative 159 million
Mm.
rupees. This turnaround shows they're generating cash from their main business, which is really important as they keep investing in their expansion.
So even though their profits went down, they're actually making money, which means they can fund at least some of their growth without just relying on borrowing.
Exactly. Now their net cash flow from investing activities, which includes their spending on things like property, plant, and equipment, was negative. But that's expected because they're using cash to build those new locations.
Like they're spending money to make money.
And their net cash flow from financing activities was positive, which shows the money coming in from their increased borrowings.
Okay. So they're spending cash on investments, bringing in cash through financing, and most importantly, they're making cash from their operations.
Yes. The cash flow statement shows us a company that's putting a lot of money into its future, using a mix of their own cash flow and outside financing to fuel its growth.
Sounds like they've got their financial ducks in a row.
I'd say they're managing their cash flow well, even with this big expansion. But like I said, it's important to keep an eye on those debt levels and how quickly those new outlets start contributing to their profits.
For sure. Those are definitely things to watch. These financials have given us a much deeper understanding of Landmark's financial health and the strategic decisions they're making. But there's more to this company than just numbers.
Oh, absolutely. Numbers only tell part of the story. There's a lot more to understand about Landmark's approach and what drives their success.
Okay, well, stay tuned because in part 3, we'll go deeper into those strategic highlights and find out what makes Landmark stand out from the competition. All right, we're back for the final part of our deep dive into Landmark Cars Ltd.
We've crunched the numbers, explored their financials. Now let's really dig into what makes this company tick.
Yeah, it's one thing to see impressive growth, but what's the strategy behind it? What are they doing to drive this success?
Well, their growth framework is built on three main pillars: strategic partnerships expansion into high-growth areas, and a laser focus on operational efficiency.
Okay, break those down for me. We talked about their partnerships with big brands like Honda, Jeep, and Mercedes-Benz.
Right. Those partnerships are super valuable. But Landmark isn't just sitting back. They're actively looking for new partnerships with other fast-growing premium brands like MG Kia and Mahindra.
Smart move, especially with SUVs and EVs getting more and more popular in India.
Exactly. Landmark is aligning themselves with brands that are hot today and also have the potential to be major players in the future of the Indian auto industry.
So they're anticipating the next big wave and getting ready to ride it.
Precisely. And their expansion strategy goes hand in hand with these partnerships.
Right. It's not just who they're partnering with, but also where they're expanding.
Absolutely. They're strategically targeting emerging territories with high growth potential, places like Hyderabad, Jaipur, Patna, Goa. These are areas where demand for personal vehicles is expected to skyrocket in the coming years.
So they're getting in early, establishing a strong presence in markets that are ready to take off.
Exactly. And to make the most of this expansion, they're super focused on operational efficiency.
Okay, that sounds interesting. What does that mean in the world of auto retail?
It's all about streamlining processes, optimizing resources, squeezing every bit of value out of their operations.
Making sure every rupee counts. No waste.
Exactly. They're implementing cost-cutting measures across the board to boost profitability. They're also exploring innovative approaches like co-locating select outlets, combining showrooms and workshops for different brands under one roof.
Oh, that's smart. A one-stop shop for customers. Convenient and efficient.
Precisely. And this focus on efficiency extends to their inventory management. They're actively managing inventory levels, making sure they have the right cars in the right places, minimizing the risk of overstocking, and maximizing their sales potential.
We talked earlier about how they avoided that huge inventory backlog that hit the industry in September. That's a testament to their strong inventory management.
It is. They're operating in a volatile market. And their ability to adapt and optimize is what sets them apart.
So we've got strategic partnerships, smart expansion, operational efficiency. Sounds like a winning formula.
It does. But there's one more crucial ingredient to Landmark's success: their leadership team.
Ah, yes. The people behind the strategy. Tell me about the folks at the helm.
Landmark's leadership team is a great mix of seasoned industry veterans and dynamic new talent.
The perfect blend of experience and fresh ideas.
Exactly. At the top, you've got Sanjay Thakur, the chairman and executive director. He founded the company back in 1998 and has led it through over 2 decades of growth and change.
He's seen it all, navigated the company through all the ups and downs.
He has. And he's built a strong team around him, mixing experience with new perspectives.
Give me some examples.
We've got seasoned executives like Surendra Agarwal, the CFO. With over 20 years of experience in finance and accounting, he brings a deep understanding of financial management to the company.
Strong financial leadership is so important,
Yeah.
especially for a company growing this fast.
Absolutely. And then you've got leaders like Garima Mishra, managing director for Volkswagen Jeep and group marketing. She represents the new generation of leaders, bringing fresh ideas and expertise in areas like digital marketing and customer experience.
So they've got the financial smarts, the operational know-how, and the marketing skills to navigate this ever-changing Indian auto market.
They do. And it's not just about profits. Landmark is also committed to sustainability.
Oh, that's great. What are they doing on that front?
They've launched a huge tree planting program with a goal of planting 100,000 trees by 2030. They're also using energy-efficient technology in their showrooms and service centers, reducing their carbon footprint.
So they're taking real steps to be more environmentally friendly. It's good to see a company that cares about more than just the bottom line.
Definitely. They even have a catchy slogan for their sustainability initiatives: Roar, reduce to zero, add responsibly.
I like that. It sums up their commitment in a memorable way.
It does. So, yeah, it seems like Landmark is trying to do things right, balancing growth with responsibility.
Well, as we wrap up this deep dive into Landmark Cars Ltd., it's clear that this is a company on the move. They're not just riding the wave of growth in the Indian auto market, they're actively shaping their own future.
Absolutely. They're a dynamic force in the industry, making bold moves, forging strong partnerships, and embracing sustainability.
It's been fascinating exploring Landmark Cars with you. We've covered a lot of ground, from their financials to their strategy and their sustainability efforts.
We hope you've learned something new about Landmark Cars and the Indian auto market.
And if you want to learn more, we encourage you to check out the source material. There's a ton of great info out there.
And as always, do your own research and form your own opinions.
Until next time, happy investing, and may your deep dives be ever insightful,